Well, good morning everyone and welcome to the Magellan High Conviction Fund live webinar. My name is Mark Burgess and I'm part of the national distribution team here at Magellan. This is the first webinar we have held showcasing the High Conviction Fund strategy, and it's great that so many of you could join us today. The fund has just ticked over its 5-year anniversary, has over $550 million of funds under management, and has a tick under 17% per annum returns since its inception back in July 2013. Now, I'm shortly going to introduce you to the two portfolio managers, Hamish and then Chris Wheldon, who are going to take you through the fund, how it differs from the global fund, and thirdly, the current portfolio positioning. So without further ado, please welcome Hamish.
Thanks, Burjo, and thank you everyone for joining the call. For people who don't know me, obviously I'm Hamish Douglas. I'm the balding older guy here. I'm delighted that Chris Wheldon's also joined me today, who's co-managing the portfolio with me. I think Burjo's right. It's now got a 5-year track record. This is really a pet fund of mine. It's a best ideas fund. It's something I feel passionately in. It's not suitable for all investors because of its nature and its concentration, but I do think it's a very interesting fund for people who are wanting a concentrated exposure to some best ideas. So what are we trying to achieve in this fund? What we're trying to achieve for people is we want to generate superior investment returns. Our investment objective of the global fund is to earn a return through the investment cycle of 9% per annum net of fees. The High Conviction Fund is obviously a subset of our best ideas, so we're wanting to get superior returns over and above our global fund, and we've set an investment objective at least 10% per annum net of fees as a long-term target. I'll give some analysis a little later on in how we've gone against that objective. Now we've got a 5-year track record. What is this approach? It is an approach of investing in a concentrated portfolio of 8 to 12 investment ideas. It comes out of the same investment philosophy of our global fund. We want to invest in a portfolio of outstanding businesses that have very long-term demonstrable competitive advantages that earn excess returns on those capitals. And of course, we want to buy them when we think the prices are attractive, and by definition, if they're our best ideas, they're probably the most attractively priced investment ideas we have out of that universe. It actually doesn't have many constraints in this portfolio. Our global equity fund can hold up to 20% cash. We can hold up to 50% cash in this high conviction fund, which is probably appropriate given the extra concentration we have in the fund. And this is also very aimed at high net worth and more sophisticated Australian investors, and we've got an active foreign exchange currency program involved with this fund. And we're very happy to give additional details on how we hedge the currency to anyone who would like to approach our distribution team. What do you get exposure to in this fund? Well, first of all, you get exposure to our entire investment team. We've got almost 30 investment professionals at Magellan. Our investment research is incredibly deep. We do not cover thousands of stocks. We cover relatively few stocks in the hundreds, and we've got a very large team doing what we describe as inch wide and mile deep research. Out of that, we hope that we can get some real insight and understanding, and we understand what the valuations of these businesses are. Of course, we also incorporate our macroeconomic research. We're running around 19% cash in this fund at the moment, which I believe is the highest cash we've run in the High Conviction Fund over the last 5 years, and that's because we're very cautious on markets at the present time. And then we also bring a thoughtful portfolio construction. Even though it's 8 to 12 ideas, we're never going to put all the fund correlated to the same investment idea. We think about aggregation and correlation risks as we construct the fund, and Chris can talk about that when he outlines the many different investment themes that we have in the current portfolio. The team of course is Chris and myself. Chris actually joined Magellan well back, I think, Chris, at the end of 2007 or beginning of 2008. I was very lucky. I actually met Chris at a Berkshire Hathaway annual general meeting in Omaha. That's actually where we met, and I interviewed Chris all those years ago. So he comes with a lot of the same philosophical background that we have. What is it? Many of the names, anyone who's been invested with us in our global fund will recognise many of the names that we hold here. They are our best investment ideas. So if we started with the global fund, of just to get a feeling of what it really looks like, we've put at 30 June here what all the holdings we have in the Magellan Global Fund. And it's listed out from at the top is the largest investments, and we move down to the lowest weighted investments in the portfolio. What is the high conviction fund? You can see we've shaded out all the investments that are in both funds, and you can see that the high conviction fund is actually a subset of the ideas in the Magellan Global Fund. You could have one or two investments that would be different for various reasons, for construction reasons. It's not always going to be the top 10, because we could then correlate into too much concentration. So you can see that MasterCard and Visa Card are in the top 10 investments of the Global Fund, but it would be unusual that then we would put two very large positions in two businesses that are very, very similar to each other in our high conviction fund because of the additional stock concentration. That really comes down to risk management. So to really think about it, it's a concentrated view of our best investment ideas. This isn't a completely new fund doing completely different things. It's out of the same intellectual capital and thought process. So the big question is, now we've got 5 years, and I think 5 years is an appropriate time to really properly assess what a fund like this could look like. Let's look at the investment performance of the high conviction fund over the last 5 years. The first thing we look at is how have the individual stocks gone. Our best investment ideas have generated very, very substantial value. We don't get that caught up in telling you how well we've done in Microsoft or Visa, although we're going to do a case study on Visa, and we're telling you that for a different reason. What we get very focused on is the mistakes we make, and we've highlighted that we believe in this fund we've made two investment mistakes. One was an investment we made in Tesco, and another one was in CVS Healthcare. It's interesting, any of the top 4 or 5 investments have actually delivered more return than the worst investments we've made in this fund. But it's very important we do our homework in a high conviction fund, and the batting average really matters. At the end of the day, we'll be very honest and transparent with our investors when we make mistakes. I think we've written, and I've written in the past, around both CVS and Tesco. I'm not about to go into a therapy session on the call on those investments, but I think our fundamental research and our decision making in a concentrated high conviction fund has been very, very solid over its first 5 years. What has this ended up delivering for people over time? Well, people who put $10,000 in on inception of this fund have more than doubled their money. Net of all the fees to Magellan, it's delivered nearly 17% a year in Australian dollars to investors. We have an investment objective of above 10% per annum. Clearly, we've done materially above that, but markets have been very favourable over this 5-year period as well. How does it go? If it's a subset out of the global equity fund, you would expect that this would deliver, with maybe some more volatility, superior returns to our global equity fund. And you can see over the 5 years, it's delivered 2.5 percentage points per annum above our global fund. And our global fund has delivered very good returns over time, but actually over each time period, this fund is delivered over 5 years a premium above our global fund returns. And as I say, the global fund returns have been very strong. And it's not surprising, if you are concentrating your fund in the best ideas you have, you would hope that you're going to get a better outcome, but it is more concentrated, we're taking more stock risk, and there's some more volatility involved in the nature of what we're doing here. So I just want a bit of caution here that people fully understand the nature of this this fund, and think about the type of investors who would invest in a more concentrated equity fund, and whether they're really equipped if there is a bit more volatility. If we get one of the stocks wrong from time to time over the short term, that could have a material impact on the short term performance of the strategy. The other question is, how do we go versus the MSCI? Of course, this fund looks nothing like the MSCI. The MSCI is 1,600 securities in 23 developed markets around the world. We've got a fund that is in 8 to 12 securities. It can't possibly look like, but over the longer term, we believe our 10% net of fees return will beat any market index over the longer term. So in the short term, we look nothing like. So what we've actually shown you here is what the 3-year rolling returns look like. We think rolling returns over 3 years are the critical period to assess a strategy versus the market. The thing about rolling returns is really like watching a movie. You can just pick 30 June and look at 3 years ago, 30 June. That's giving you one snapshot on one day what a fund looks like. You could take that same picture a month later and the picture could look completely different. So what we think is very important is taking a picture every month over 3-year rolling periods and look what the consistency is. And since we've set up this fund, we had to wait for the first 3 years, but we've had, I think, 24 or 25 monthly periods since that. And every one of those monthly periods, this strategy has outperformed the MSCI, as you can see on this chart, and has delivered excess returns in a very strong market over that period at around 2.5%, slightly above 2.5% on average above the MSCI in a very strong market. And of course ours is net of fees, as it should be in evaluating the performance. What I'm now going to do is hand to Chris Wheldon, who manages a strategy with me, to talk about how we're currently positioned the portfolio.
Thanks, Hamish. So let's spend a few moments talking about portfolio positioning. And you've heard Hamish refer to best ideas a number of times already this morning. And you can see on the screen in front of you that we've invested clients' capital into 11 very high quality businesses. You can also see the 18% cash position we held at 30 June, reflecting our cautious outlook. But what is it about those 11 investments that make them our very best ideas? There's two things to think about here. The first is that all of these businesses are outstanding and undervalued companies. They are all advantaged and dominant in the markets and the industries in which they compete. They all have what we refer to as an economic moat around the business, protecting it from competition. And the second thing to think about is that each of these businesses benefits from some sort of growth tailwind, sometimes cyclical, but generally these are long-term, enduring, secular tailwinds that will drive the earnings and drive the intrinsic value of these companies higher into the future. You want to think about growth drivers like the shift in advertising from traditional media properties to digital platforms, growth drivers like emerging market consumption, or the shift to a cashless society, aging populations. The thing to take away from this is, even within a concentrated portfolio of outstanding businesses, investors in the fund are getting exposure to a variety of different but long-term and enduring growth thematics. And a similar dynamic exists when considering geographic exposure. One could consider geographic exposure on the basis of domicile, where these 11 businesses are listed and where they trade. And on that basis, one could conclude that the High Conviction Fund is simply a US portfolio. We'd suggest that there's a more appropriate lens through which to consider geographic exposure. And we suggest looking through the lens of where these companies generate their revenues. Where are the transactions taking place? Where are the consumers? Where are the underlying economics of these businesses originating? And again, on that basis, you can see that even within a concentrated portfolio, clients are getting real geographic diversity. So to conclude the prepared remarks, Hamish and I thought it would be instructive to review the Visa investment case to bring to life one of these best ideas. And there's a number of reasons we picked Visa, but one of those reasons is the fact that it has been the fund's best performing investment since inception. The fund made its initial investment in Visa back in November 2013, just a few months after the inception of the strategy. And two important things have driven the returns from this investment since that early initial investment date. The first is that Visa's share price has increased 2.6 times since that initial investment, a 2.6 times increase in the share price in less than 5 years. The second thing is that, and as you can see on the bottom of the screen in front of you, even from that initial investment and all the way through to today even, Visa has had a meaningful position size, which is really important. When you find these outstanding and undervalued businesses, concentration matters. Concentration really works for you. And the combination of those two things, Visa's share price performance plus that meaningful position size, has meant that investors in the fund have benefited from a annualized return of above 30% in that Visa investment. So what is it about Visa specifically that allows an investment to compound at such high rates of return over a number of years? And why does it remain one of our best ideas today, in spite of that very strong recent share price performance? Well, the first thing to consider is Visa's highly advantaged business model. Visa sits in the middle of a network, and on one side are the consumers, like you and I, who use Visa's debit and credit cards. And on the other side of that network are the merchants who accept Visa's cards. Visa provides the infrastructure upon which all of those transactions take place, and it clips the ticket. It extracts some of the value of each of those transactions to generate its revenue. But every minute that goes by, every minute, Visa is processing over 200,000 transactions on that network. And it's a very powerful business model. It benefits from something we call network effects, where because it is the incumbent in the industry and so many people use Visa's cards, merchants are very willing to accept Visa's cards. And because so many merchants are willing to accept Visa's cards, it encourages more people to use Visa's cards. And it's this very positive and reinforcing feedback mechanism that is the network effect or the moat that protects Visa's business and its economics from competition. Now, the second reason Visa remains a best idea today is its highly attractive economic model. And that economic model begins with its purchase volumes, which is the value of all of those transactions that take place across Visa's network. And you can see that those transactions have compounded at a 10% rate annually over the past decade. That is being driven by the growth in global consumption, but more importantly, it is benefiting from this transition from payments via cash and check to card-based payments. Now, we've just spoken about Visa's economic moat and its highly advantaged business model, and that means Visa has pricing power. And you can see that over time, Visa's revenues have grown a few points faster than its volumes. Now, Visa's cost structure is largely fixed, which means that as its volumes and as its revenues grow, more and more of those incremental revenue dollars drop straight down to Visa's earnings. And you can see that in the progression of Visa's margins over the past decade. In 2007, the company earned a 30% operating margin. Last year, it earned a 67% operating margin. The company's margins have more than doubled in a decade. And finally, because Visa requires very little in the way of incremental cost or capital to grow, the company can take these growing earnings and cash flows coming out of the business and use that capital to repurchase its own shares, such that earnings on a per share basis or earnings per share have compounded at a 30% annual rate for over a decade. But we spoke earlier about a lot of these growth thematics being enduring and long-term, and Visa will continue to benefit from a number of these long cycle tailwinds. Visa will continue to benefit from the growth in global consumption. It will continue to benefit from this shift in cash and check-based payments to card-based payments. But there are new things. Commerce is shifting to digital channels, e-commerce, mobile commerce, and in these new channels, cash and checks are largely absent. When we transact online, we are required to pay often with our credit cards or our debit cards. Visa is an enormous beneficiary of that. And Visa plus its peers are getting into new payments categories. Categories like business-to-business transfers or government-to-consumer transfers, where there is an enormous addressable market size. And that's the final reason why Visa remains a best idea today, is that it is good value. You combine the strong and advantaged business model that it has with the secular enduring growth drivers it has, And these drivers will push the company's volumes and revenues and earnings higher into the future. So for those reasons, Visa remains one of the best ideas we have today, notwithstanding its recent share price performance. And before we throw back to Mark for the Q&A section, we thought we'd just provide a bit of detail around how investors can access the High Conviction Fund. The original units, as Hamish and Mark have referred to, were created back in July 2013. But in November of last year, we created a second class, a Class B unit. And in front of you, you can see the different fee structure and cost structure of those two units. Now, importantly, the Class B units have been created to target the managed account market. And you can see in the middle part of the screen there, the platforms upon which both of those classes of units are available.
Thanks, Chris, and thanks, Hamish. That, in the interest of time, that concludes today's webinar. Thanks very much for your participation and your attendance. There will be CPD points available for this. There'll be a feedback form which we'll send to you early next week if you can complete that. Any questions that weren't addressed in the interest of time, we're happy to answer. Please put them down in the feedback form and we'll get back to you. Any other questions that you have around the availability or platforms, for example, the research ratings, which I should mention, we have buy ratings across Lonsec, Zenith and Morningstar as well. But if you need any further information, just please contact your local Magellan representative. On that note, thanks very much and enjoy the rest of your day. Thank you.